Hi there, Alpha team. Planty here again with a weekly preview. Now, as much as we love to give you our views on the market, I think it's time that we put in the appropriate warnings and just take a couple of moments to look at the start here. All views contained within this are our own views, and they don't constitute financial advice, but I'm sure the majority of you know that anyway, but just take that into consideration. So, preparing to leave the nest. I've been getting on about this nesting idea in the markets for a number of weeks now. If you play waves, you kind of will probably understand that, but I'll show it on a chart later. But generally, that this is waves that are at varying degrees having a surge up, a retracement, or a retest, and then all building up time after time at different degrees, different time frames, different levels. One twos, and on some of the charts, there's probably about 6 degrees of nesting. What that means is they're about to break out into third waves. That's where all the power's done. And because you get this concertina effect of wave after wave, this is why third waves generally look bigger. It'll be very difficult finding order blocks to stand in the way of things like that. You'll just be whipsawed up every time you take it on. And you start to see a little bit of that kind of action in gold on Friday, and potentially some of the indices are beginning to look like that. So we'll talk about that a little bit later on. We've got budget this week, and Hunt is already over the Sunday papers saying that he's going to be prudent, which is my view. He's got very little room to do anything. So that's probably a nothing done on Wednesday, but we will have a look at the details as they come out. Now, we've had a couple of good weeks here. We've had Nvidia and the earnings really justifying the move. We've changed the narrative a little bit to growth. Rates have obviously pushed back from 7 rate cuts or 6 in the main in the States from the start of the year. Europe was similar. And, particularly in the States, we've got it under control now with an expectation of 3. And now the narrative's changing to, will there be any rate cuts at all? And we'll discuss that. But last week, we got some decent reaction to what at best can be described as becalming. So PCE, we talked about the PPI read through previously. We knew that was going to be going up. The market consensus had moved there, so some people have been asking about that. And there are plans afoot for more education and more chances to talk about macro and how it works with me. But please, we're starting to see a lot more engagement on my chat. Continue that. Ask any questions. I will get back to you. I know some of you are waiting for answers. They are coming. And let's keep engaging that way. Because, as I said, the read-through for PCE came in line with an uptick. And I'll demonstrate the maths to you in a bit. We've got to be careful. If we stayed at the level we've just had for the rest of the year, there won't be any rate cuts. So we do need that to calm down. And the reason next week is going to be quite interesting. Yet again, it seems to be week after week at the moment. Seasonality, we've been talking about our January print, strange. Normally, the seasonality that happens in January is down to goods inflation and goods jobs, things that get affected by the weather. So you get big spikes when things return. Tends to be on the good side, and we aren't seeing any that prices paid in the manufacturing unwound this week. Where it is showing is in services, which doesn't normally happen as a seasonal effect. That is the danger. Services is the biggest part of the economy. We've got ISM services this week. We want to see that prices paid under control. Otherwise, people might start unwinding last week's good work. But more of that later. So let's have a little look at what happened last week, really. We went through so many talking heads, and they keep on continuing. And I've heard other people now begin to come around to the same idea. It's like a guessing game. A bit of, as I'm saying here, guess who said what? We need to buy one or create one at Alpha, bang it in the store, along with those buying boots that we showed you on Friday. So, there'll be lots more of that coming up. And obviously, it's the daddy boy non-farm payroll at the end of the week. We'll have a quick summation of where the market is later on. But last week was important. There's lots going on. And let's have a quick review of that and pick out a few highlights. Not much from the talking heads. Monday was pretty dull. I thought something interesting was from the head of Buba, Nagel, who was saying that 3.3 on euro inflation last month was too high, needs that down, and we did get data on that during the week. What he really was questioned on was whether it was still viable, the Bundesbank, that had reported a loss of 19 billion for last year. But he said there's a lot of things in the pipework, a lot of stuff behind supporting them, and they have been one of the bigger buyers of gold of late. They've got a 200 billion euro reserve in gold. So that just highlights where this demand is coming from on the shiny one. And Lagarde wasn't really meant to be saying anything special. She was in front of European Parliament, but she talked about how their restrictive stance on rates had helped stop a wage price spiral. So again, she's leading it back to that wages narrative and giving some direct comparisons for the politicians. Tuesday, a lot more interesting last week. Japan came in with an uptick on the CPI, which helped up get everyone's minds back on the fact that this could be escape time. Then we had something in US durable goods, and hopefully I've left you with a picture in your mind when these come out. Go forward. It's the king of the bulls himself, Michael Jordan. He doesn't go for layups. It's always a slam dunk. Remember that picture that I put up there. There's no defense to Michael Jordan, and there's no air either. The picture's not got his Air Jordans on, so that's how to remember what you're looking at. Durable goods, ex-defense, and ex-aircraft. Thing that I noticed, US confidence figures were down despite all this sort of good news, and that got reiterated later in the week with the Michigan surveys. But hidden within that is jobs plentiful minus jobs non-plentiful, and that is still above the long-term average. So the pullback in non-farm payrolls might not be as big as people are hoping, but we'll see. We don't really cover anything in Nigeria, but I know there are a number of people on the site, and they were showing how horrible times are with the breakout inflation over there. They had a big rate rise this week, and that just shows you why, despite the fact we give them a lot of hassle, I'd rather have the central bankers erring on the side of caution than letting things get out of control. So just keep that in the back of your mind, just how things can go badly wrong. There's a lot of chatter on US government. They did sort it out in the end, or another kick the can down the road. Something I heard was that US bond sales, absolute record for US bonds coming to market. That provides the fiscal money for them to do all these programs. And the prices were one standard deviation below the bottom of the range. So a little bit of pushback. Yields were under pressure during the week. And, it's been kind of keeping, a hold on the reins of the dollar sell-off. The rates have been hanging up there, but, the data is beginning to go our way, and we'll talk about that. Government of Bank of England Governor, Deputy Governor Ramsden, still talking about don't take things for granted. Inflation's still too high. None of this is written in stone yet. So just be careful. Then we had Wednesday, Royal Bank of New Zealand overnight. I saw some people on the chart room chat had made money out of this. There was no rate change, but they changed the commentary. In November, they'd said that inflation was failing to sufficiently cool, and there was still a risk of a rate rise. They removed that, so that suddenly saw the New Zealand dollar selling off. Aussie CPI was mainly in line. Japanese retail sales actually flat to small up. Remember, their GDP crash 2 weeks ago, I think it was down to consumer. So maybe the forward-looking data is a little bit more supportive. And then within US GDP on Wednesday, their PCE element, as a forward indicator for us going into the actual PCE, was under control, only a slight bit up at 2.1. But there's a few stocks in the UK that were out there talking. Taylor Wimpey, they're seeing fewer houses built. That's more of hopefully something that gets sorted out in the budget, but the planning regulation's terrible in the UK. Aston Martin, they said the super rich are spending, and that comes up in the comments of some of the talking heads. But you'd have to be mega rich for an Aston Martin top of the range. $480,000 a year for a servicing cost? Don't think so. Vodafone and BT, 10 years, still at the bottom of the performance range, down 70 and 75%. Vodafone announced it's finally going to start lobbing some things out, get rid of the Italian arm. It's had a little bit of a lift up. Now, this shows you why people are intent on buying growth stocks. Reckitt Benckiser, massive, what they call a staple goods stock, which is literally the safety stuff, the defensive. It's a defensive stock. It's what you should be buying. People, household goods, have to buy the stuff, so that shouldn't have a lot of volatility. You go to it in times of safety. Absolute shocker, down 10%. Missed on everything: volumes, organic growth, margins, and costs. Maybe a lot of this is stock specific, but that you'd rather lose your money having to go on something that can double or triple rather than these boys messing it up. And NatWest possibly coming back to market. UK needs some cash for the budget coffers. They're talking to Hargreaves Lansdown and AJ Bell how to get that back to market. Keep an eye on that. Apple gave up on the EV car, so that put them under pressure all week. Lowe's was solid. Macy's announced a bold new chapter, basically having to lob out 150 stores that have been underperforming, restructuring basically, and they were struggling, down 10%. Bud, super flat, just like it is when you pop the top off. That stock was down 4%. There was a big shock to oil inventories last week, 4.199, but again, it's down to the unexpected shutdown to the refineries. So the oil's having to back up until it can get processed. So, in a way, that has it's helped put a bit into the market, but oil inventories piling up. It's not a problem. That's not necessarily going to cause supply issues going down the line. That will unwind, but we know that there's already an oversupply in that market, which, unless demand massively picks up, is going to bring that rattling off. And we'll have a look at that again later. So it's talking heads warning, and you know what that means. Loads of them. The one that I could not believe that came out of Bank of England's Catherine Mann blamed the rich for spending disproportionately, basically saying people are travelling, eating out and having entertainment. Well, as I say there, hope she enjoys the knitting. What on earth is that all about? ECB guys still no change, leaning towards June. Casimir and Louis de Guindos both saying that it's going in the right direction. And then some of the New York guys, President John Williams, they will start cutting if it moves towards 2%. Bostic, he has got a better comment later in the week, but he's still saying every time he comes on, not declared victory. And Susan Collins still saying the road might be bumpy. So all dull, passing the cards round again. So leap day, leap year, 29th. Alex brought the 30% off back. Did the ladies out there, did you do your proposals? Are you down on one knee? Make a proposal for rate cuts. That's what we're looking for. And Takata overnight didn't disappoint. He gave us his view that already wages were getting embedded in the system, starting to see the chance of getting back on the escape velocity train, and it won't be long before your yield curve controls can be removed. Blah blah blah. But expect them to do it in baby steps. After that, 4-1 on it went that there'd be a rate cut in April, 80% chance. But as you'll see on Friday, that all came crashing down. And I put something there that, interestingly, in the Nikkei and the topics, the residential institutions and the Japanese retail, the ordinary punter like you and me, aren't buying. They're all underweight this year and the last 6 months. All the buying's been done by overseas people. Well, they'd like to see the yen strengthen, but we're already at highs. But to me, that means we need an encouragement for people to do the unwind of the carry trade. They need to bring that money home and have somewhere to invest. Very much looks like the Nikkei is the place. Over the last 2 years, they've already had the highest rate of upgrade change of any major market. So, if we can get some momentum in this stronger yen, weaker dollar, and both of those might be happening for different reasons, for a double whammy, and you've got investment performance in the Nikkei, it's happy days, isn't it? Stock-wise, Haleon in the UK showed household goods are not as much a mess as what Reckitt's made out, so that's probably all down to them. Ocado was seeing faster growth, but it was all held back, having a public spat about whether they hit the right metrics to get the last payment from M&S for their shared retail delivery business. So that was all a little bit doing your dirty washing in public. We don't like to see that. Some of the minor indices are starting to react to what we are now seeing as stronger metal prices. We were talking about that last week, and it's been pushed as a contrarian trade into the underperforming miners versus some of the things like luxury and tech. We sent a meme out about M4. That I like to look at the money supplies because that tells you when that's contracting, either the QE is being pulled in or nothing's happening in the economy. The basis of money supply is that it moves around. You get a multiplier effect. So we lend to a bank, the bank lends it to someone else. They may lend it on, it qualifies for a project, blah, blah, blah. And the money goes round and round. But if the money supply is going down, actually contracting, that's not a good sign. There's less of it to go around. And as I said, my favourite, if you go down the M4, just before there's a little kink and you go south, you've got Slough, and it's very, very sniffy on that motorway there, this Slough sewage works. So I said, be careful, hold your nose. If we're going to go south, we need to get off at Slough. EU regional CPIs, all of them came in more or less in line. France was slightly up. We were waiting for Italy on Friday, but the expectations for 2.5%, given those underlyings, we wasn't expecting anything worse than that, and I think it came in at 2.6 in the end. I think Bitcoin is just worth mentioning. We don't trade it, but it's continuing to surge towards 69,000 high on the futures. It's hit 64,000 again, first time in ages this week. Lots happening under the hood there. If you've been watching, the ETF obviously has been legitimised. They're all having a little melt up. April, we'll see the 4-year halving event. So the supply is going to halve. We've got demand for the ETFs. Again, a bit like the Japanese yen. Could have a double whammy. We are having it in that one. And the whole thing's surging, isn't it? So we were all about what's going to happen with the core PCI, drum rolls, bang in line on the revised up number. Now, I'll talk about that soon because that's a good thing and a bad thing. Initial job claims were noisy, up again this week, having been down, up and down last few weeks, but they're still showing, and suggesting we'll still have that low unemployment rate on next Friday. Personal income was a surprise. I mentioned it on the day. That was all due to dividends received and payments, redemptions in the tax things at the end of the fiscal year. And that came in at 1% as a result, a big beat by 0.6% on expectation. Not a bad thing, really, because it's going to help the consumer. Personal spending came in line. Canadian GDP was solid, not run away, nothing to worry about there. More soft home sales data. And going into ISM manufacturing, Chicago PMI was soft versus what was supposed to be an uplift. Stock-wise that we'd highlighted throughout this week, Snowflake, which was a darling stock, came to market a couple of years ago, the highest ever IPO, $3.4 billion in the software space. That was down 20% this week on a slowing outlook for its cloud side. But again, they've been trying to morph towards an AI stock. And that's probably a clever move, so we'll look at what they do going forward. Salesforce, a little bit lackluster, but they managed to eke out gains. That's another sort of tech darling, an ERP stock, enterprise software. First ever dividend and an increased $10 billion buyback. So they actually bounced up in the end. So that brings you on to another point. There's a lot of stock buybacks going on. And in the Q4 earnings season we've just gone through, that was up a record $203 billion for the quarter, 20% up quarter on quarter from Q3, 8% year on year overall. So how does that work? Buybacks. So companies are either scared not to do a buyback because they think it will signal to people that they don't believe their share price, or they really do believe it's massively undervalued and they're going to steam in. They've got no other better projects to do with the money, and they can get more share price performance out of buying their own stock. It's a moot point. There's lots of studies over different periods that prove or disprove that, but net, it's very supportive for the market. And I'd lean towards it being a signal that stocks are still slightly undervalued and are going up, because that's the first year-on-year change for a couple of years since 2022. So genuine reasons to be buying. There is growth in the system. I think that is why the buybacks are increasing. Unless, of course, you're at Weight Watchers. Now, if you lost 22% during the week in a couple of dress sizes, you'd be over the moon and you'd be slimmer of the week. But not if people are investing in your stock and you've just lost Oprah Winfrey running down the road. So it's not all easy out there. No, it's not easy to lose the weight and keep it off. And the Senate on Wednesday finally managed to kick the can down the road. We've pushed the date back to March the 8th, and that pushes it back a couple of weeks, the money cut-off point when they do have to actually put up or shut up. They've got a week now to get 6 bills through the House, so there'll be lots of gerrymandering. One of the Republican Senate leaders had to fall on his sword to get that deal through. So again, talking heads warning, get those moves out, come on. The last few inflation readings, Bostic said, including PCEs, it's the first comment since PCE came out, have shown it's not going to be an inexorable march that gets you immediately to 2%. But there are going to be some bumps. The slope is still going down, and he thinks it'll still be appropriate to cut rates sometime in the summertime. That's still encouraging, because later on there are people telling me that there won't be any rate cuts at all. Goolsby still making progress. Don't extrapolate too much from the January figure. So he's quite dovish, as we know, and he's being just be sensible. These things can unwind, and we are beginning to see that. Mester from Cleveland, she's still more work to do. She's looking at today's PCE, still anticipating 3 cuts for the year. And she's one of those that thinks that the banks still need to have more reserves, a little bit of a tightening bias there. There's lots more in the Fed that have a complete opposite view at the moment. Williams remains adamant that they will start cutting before the year's end, but needs conditions to say why. And Mary Daly, she said officials are ready to lower rates as needed, but no urgency given the strength of the economy. And there's less forward guidance now because they're gone explicitly data dependent. So you won't see them necessarily moving their dot plots or the commentary around too much. They're literally playing it, ball by ball is a way of looking at that, trying to manage it. So I mentioned this a couple of times today in the preview, and it's a maths moment. So take cover if that brings you out in a sweat. I think it's a case of rate cuts when, not if. But that figure, despite the fact we've seen a little bit of euphoria in the market, that PCE spot for month on month, if you extrapolate that and do the maths, 1.04 to power 12 for the year for a simple inflation rate, that gets you to just under 5%. The Fed wants to be at 2%. Interest rates are at 5.5%. Do you think they're cutting if it plays out like that? Not a cat and house chance. So if you work backwards from 1.02, 2% PCE inflation, that would be telling you need to see spot 1.6, spot 2s, which was the original forecast for this month until the PPI came through. We need to see that coming off. And within PCE and CPI differ massively. I've said before that there's massive rent percentage in the CPI, which is why the Fed in itself moved to a more broader measure of the economy, which is what PCE is. But they both have their faults, and in the PCE they have to make some numbers up. They impute what you might have paid if you bought this insurance or that transaction in something, whereas CPI is always a measure of what the prices are in the market. So the way that can differ is, say, motor insurance, that is up 20% on the CPI this year. What you've basically had to pay. So you factor in the interest rate cycles, the insurance cycles, whereas the PCE measures the total value of an insurance contract with all the companies within that. And, the rate cycle, the insurance cycle might have gone up on one bit, but some players in the insurance section of that might be swallowing some profit margin. So, one's up 8% and one's up 20%. Totally different thing, all about the same item. They've got the same thing with airlines. It's worth about 1% of the weight, but when airline tickets that you buy online can move 8% on a daily basis or a week, and they're using that to measure, you're suddenly doing 1% of 8%. That's 8 basis points, much bigger weighting than it should ever have in CPI. So these things are volatile, but we need to get them under control. And probably net the PCE, I can see why they use it. It is broader, and a lot of the things seem to be a little bit smoother and slightly less volatile than the CPI. Friday, overnight, and I think we sent it out in the end, but I did a black rain with the bad character holding his sword, and that was Governor Ueda, because he was chasing after Jimmy Takata, saying, "You want some cuts? I'll give you cuts." Saying it's much too early to go either way. He's trying to play it down. He's the main man. Swaps markets continue to keep it in that there may even be a cut in March, but we just can't get away from this sub or above 150 yen to the dollar closes. It's every time it tries to break out, there's someone sat on it. Maybe they're trying to force the hand of the Bank of Japan to do something, but the data's going the right way. It does sound like Takata's said, where the thinking is companies themselves are beginning to pass on the wages. We're about to get the preliminary reading a couple of days before their March meeting, middle of March. on the wage shunto thing I've been talking about for weeks. Fingers crossed it all comes together. Didn't stop the Nikkei putting in a 40,000 record print for recent times. No struggle there. And as I said, they've got the highest earnings upgrade, so it's totally justified to be the outperforming index of the year. China's PMIs, they continue on the manufacturing side. Official data to be poor. The Kexin surveys, they are smaller companies done privately. They're all saying things are much rosier. Who knows? But next week, actually, I've not written it down on the preview. You've got the People's Congress, whatever they call it, in China, where they make their 1, 5, and 10-year plans. We'll see whether they grow up and let some women back into the room. That'll be a start. But we'll see what, they might give some clues as to where the likely support is going to come over the next 12 months. The Deputy Governor of New Zealand stepped in to say something, said they will stay restrictive on inflation because it is still too high. Emphasises not in a mindset of cutting, but they're moving towards the right range, so there won't be any rate rises, echoing what they said post the decision. Have we got past... It's an anniversary of the Silicon Valley Bank blowing up last year, which derailed last year's rally. People have been looking for this commercial real estate shocker from the NYCB to blow up. It sounds like it's kitchen sinked. The regulators seem happy with it, but they did give an update this week. Some idiosyncratic news. The stock was down 30%. They revealed that they've got 37 billion in exposure in apartments, which have regulated rent issues, which is set by the federal, local feds, I think. So it's an interfered with market, which has caused them problems, and they can't get the renegotiations to suit, so they're having to write off losses. I think at the moment the bears are hoping it causes trouble, but the market is seeing it as isolated. The Fed officials seem to be happy with how the credit spreads have been repriced. So after that, in Europe, the Italian CPI came in. That was in line. So it suggested it'd have to be something really funny for Eurozone to miss massively. It was up very slightly, 2.6 versus 2.5 year on year. A little bit of knee-jerk reaction, but everyone realised it was a nothing done. ECB still on wages. Looks like no rate cut coming anywhere until June, but particularly in Europe. Nationwide house price index showed some strength at the start of the year. We were looking for a bit of help. Subsequent to that, we've had results from people like Taylor Wimpey who've told us that things aren't as rosy as it seems. At the start of the year, it did look like the rate cuts were coming. Swap rates were low. We've since had pushback. So despite the fact that mortgages have been taken, houses have been bought, government's 100% mortgage guarantee was well received by the younger people. And we need to look at this in the next few weeks. Swap rates are what determine where the actual rate percentage cuts are. And we need to look at the curve and how all that comes together. Swap rates moving out, not a great thing at the moment. We need to get that coming back the other way. Friday, it was ISM Manufacturing Day. That was the big thing that we were waiting for to finish the week. And as I've said, it's ISM Manu Fill Your Bootsism. Because every metric, all 5 metrics that they release on the headlines were all weak. And that to me suggested it was time to fill your boots. Certainly gold was going to break out. We shouted that out straight away. And, that really looks like it started off the nest situation we've been talking about. There's a Goldilocks print under the hood is how I described it. Prices paid were actually down month on month. That had been the real issue last month. They'd shot up as long with the PPI. Underneath the hood, as I say, though, GDP contributors were less than 1% were in contraction. A number 45 or below is contraction on these diffusion indices. Below 50 is contraction to start with, slowdown, but actual real going down is below 45. And then that was a 27% in January and 48 in December. So the path is going the right way, and lots of respondents to that survey were saying they've got pent-up demand waiting, not necessarily higher prices, but there's activity. So we are well placed here for growth without price pressures. Michigan, I mentioned it earlier, they came in an hour later. The 1 and 5 year inflation expectations, bang in line, no pressures there. And just like consumer confidence earlier in the week, consumer expectations, sentiment, and current conditions were all weaker, along with construction spending, which was actually came in negative rather than the expected positive. So, in terms of tight markets, rates going up, it was a brilliant week, and we got the respective breakouts in the right areas. The dollar was weak, and as I'll present later, I think that continues. The indices probably keep ratcheting up. Gold itself has put in a closing high, and now it's a case of an intraday high is the next target. To finish the week off, yet again, a few more less talking heads. Are you still playing this silly what they're going to say game? Waller and Logan actually changed tune a little bit. They were talking about it's still a wait and see approach, but they started talking about the asset sales, and Logan was actually responsible for that at the New York Fed. They're both talking about keeping it slow and a gradual pace of unwind, and Waller explicitly said it needs to be a separate decision to the rate cycle. So net for the week, we started off very nervous. It was a big data week with the PCE and the ISM prices paid, etc. It does look like that was a seasonal data aberration, certainly on the manufacturing side. ECB, Bank of England, Fed all look like it's June now. It's difficult to find an excuse to go before that. New Zealand removed their tightening bias or potential tightening. Hopefully the US really just start the ball running in June. Japan, still slight chance of March and April. They're just playing around the edges, don't want to make anything go too crazy. We've mentioned it before that the carry trade when it unwinds is absolutely huge and has the potential to blow a lot of things up. So we need to do this in an orderly fashion. And I said gold is beginning to glisten. Silver's got a breakout pattern as well. Indices have continued to move up. Phrase of the week that I saw was MOMO to FOMO to ONO. So basically momentum begets momentum. If you've missed it, you've got that fear of missing out, and then everyone piles in and it's ONO. And I still think we're somewhere between MOMO and FOMO. There were two contrasting views at the end of the week that I heard, well, slightly contrasting, but both coming towards the same conclusion. Apollo's chief economist, Torsten Slot, got a lot of attention for 10 reasons why the Fed will not put rates up or take rates down at all in 2024. And that was mainly just because of how well things are going. Financial conditions good. Credit spreads, they're really tight. So they're normally high if people are worried. When they're not, they come in closer to zero relative to how risky you think they are. It's not difficult to raise money at the moment. IPOs and M&A activity is picking up. Highest January of issuance so far for years. Since the Fed pivot meeting, there's a lot of upgrades priced into macro data. So people are literally saying growth is there and we expect it to continue. So lots and lots of reasons not to cut, but I've been building that picture for weeks. It's a positive one for growth, and the rate cuts, if they come, are a bonus. And then Tal Backen's Michael Purvis is a bit of a talking head on Bloomberg. He sees 5,500 plus on the S&P. Again, driven by this now relief of no hiking, particularly coming through this week. It's a case of we're now looking down rather than up on the rates. He's saying the worker and consumer are in balance because they've got real wages going up and inflation's coming down. Plus what came through in personal incomes this week, you've got dividends and returns coming through from your investments. Unemployment's at 3.7%. Hopefully it will be on Friday. And GDP is trickling up. So you can't get a better mix. I've said before productivity, and I think that updates this week. In the US, we've got a generational shift coming with AI for even better tech conditions, productivity for tech. QE is normalizing, and the 1990s, we can look at it, but we can live with higher interest rates. I've said it before, what happens there is the strong companies survive. We're seeing evidence of that in the updates we're getting. And the zombie companies, those that were kept alive from the last crash, they're the ones that go by the wayside. They've got no real ballast to their story. So it very much looks like to me the rate situation will cause a bit of volatility, and you still buy the dips. If you're shorting, for Christ's sake, get your timing right, because if these nests come to fruition, you're going to get pistol whipped. And again, remember, some people have really been calling this as a top since March last year when the SVB thing blew up. So they're either getting absolutely buried or missing out on a lot of upside performance. And as I said, 1990s, rather than now being it's a bubble, 2000, blah, 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 people are coming around to what we've been preaching, which is this is, orderly growth that will carry on breaking out, and the rate cuts will just put petrol on top if it comes. And again, just remember, I put a warning in here again into the note. Just remember that we do need those inflation numbers to start coming down. Otherwise, rates aren't going anywhere. That PCE read through. Remember the cold shivers from the maths. So it's time for a little bit of charts. So as I said, the charts. Friday, gold had an all-time high close, which probably explains why if you were trying to fade it at all later in the day, it just wouldn't break. And the setup for weeks, we've been saying that the most aggressive setup has been the nesting 1-2s. And that does look like it's ended up being the chart of choice. And this is why it's very, very difficult to take this on because it's going to surge. Nesting is a series of higher degrees to lower degrees of 1-2 wave followed by 1-2, 1-2, never quite going for the breakout third wave, but you're building up all this pent demand, and it's like a coiled spring. And it very much looks like we might have just started the very first one of the breakouts at a really low degree. I'll show you in a minute. I've been counting, and there's probably 6 degrees of wave nest in the gold chart. So it's going to be very difficult to take this on, putting order blocks on the chart, and then I'm wondering why it's blasted through. So this week's big if the data still allows this accommodative stance, weak dollar, I'd expect to start seeing some real ratcheting up to the new all-time high above 2150. There's a target for one of the third waves around 2171, so that all makes sense. And then various others that ratchet up at a high degree. So just taking this from what they call the minor waves, the red 1s and 2, you've got a 1-2 followed by the next level down, a spike up, 1, pullback, a 2. This is why it's felt like it's consolidating. You can read it either way because even if it breaks to a new all-time high, you could still consider it. It looks like a pattern that has been consolidating. It's until we get this real continued surge that you realise it's all the thirds and then fourths and fives folding in. We will do a session on this at a much slower pace, but I say got 1-2 followed by another 1-2. Get the mouse. So 1-2 down there. You can see 1. I've got labelled up. We had this quite protracted to another 1-2, and then below this we've got the next high degree, the intermediate wave 1 and 2. So there's 1, 2, 3, 4, 5, and then Friday's surge and a slight pullback at the end, possibly 6 degrees, right down to the sort of minute level of nesting. So we'd expect small pullbacks and this to keep surging. It may even open up the Asia session classic tonight, which just continues to surge, and then you have to make your mind up. But it looks to me like the very first level is this 2171 before it properly pulls back. You can see in here we thought we'd have a pullback, which we talked about here. It was very short-lived, and then we got that continued surge right up to the close. Never really gave up anything until the death, and you got the people going home for the weekend. So, like I said, we can that. I'd put it on as a very short-term short on Friday. Did not get any of the impetus to downside, so we moved on. So the dollar quickly. We were in this situation last week where we thought we might do a double correction. That put itself in, and it put a connector in and did another little extension. We're on the way down. It very much looks like this thing feels like it's impulsive. The uptrends look like they're sideways and consolidating. We're now looking for a new surge to a new low to confirm that we're in that third level. And it could do with blowing that out, but it very much looks like there might be a downward sloping head and shoulders in this current move, in which case we break that line with a close sometime next week on good data, we will get that surge down to a new low. Obviously, looking at that chart, your obvious stop loss is what we've put in as the too high, and short term was last week's high. We don't want either of those taken out in the short term. Really, it's going to complicate matters. Indices, been talking about it for a while. I think the growth pattern and the upgrades just keep jacking this higher. It's very hard to argue the other way. People are still calling for sell-off patterns. If you've set yourself up as bearish since October 22, and that always was the case, you could put the case for it. Well, the high of 21 and end of 21, early 22 was, it all depended how you called that. That was either an all-time super cycle high, or it was the end of a first wave up from the way people have put it, from the COVID sell-off. Now, originally was leaning towards it being a long-term super high, but there's a halfway house between that, and I do think that might not necessarily. I think we may have put in enough in the interim to consider it a valid sideways consolidation, so we could easily be in new high medium-term territory here, particularly as we're still just seeing off the last bits of the COVID restraint on the market. Supply chains are sorting themselves out, and the money's normalizing, the easy money's being withdrawn, and the market and the economy are standing on their own 2 feet in the States. So at any stage at the moment, you could say that we are potentially overbought, and the 3s and 4s and 5s could easily just fold in. But to me, my experience just tells me that we're going to shoot a little bit higher here. And looking at the chart on the Nasdaq in a minute, it shows you that because of where we've got to already, and we're up against some fibs, you can redraw those to the original breakout levels we had weeks ago. And then once we hit that, that's valid for a consolidation and a number of consolidations, because as those 3, 4s and 5s ratchet through, the 38.2 fib is the likely pullback, and they all seem to align more or less in a horizontal line. So as I put in the weekly preview, today's high may end up being a support going forward. So it sounds daft to buy a high, but I think to a certain extent we might be safe doing that. So that's illustrated here. We'd messed around with the channel last week, but that yellow line there is where we've reached up to. That's a 1.236 extension of the intermediate wave down here. And then the third wave of the minor wave, the next degree down, 1.618, they're bang in line. And that's where we've hit. Now, I think from that we may have another shallow pullback potentially, but there's no reason for it to happen. And back on the top of the original trend line, not far away in the time frame, is a 1.618 extension for that original blue wave. And if these things start happening, we cascade up. And then once we start putting in the consolidations, the 38 fib from there is a 4. You'd have to put in a new high to finish it off. The 38 fib of that wave comes into a similar area. And these all keep going potentially for a couple of months, what will be called, I'll be described as eking out new highs, but also tracking sideways, going nowhere. But you'll have a nice trading range between 18,000 and potentially 21,000. And happy days, we should be able to make money out of that. Oil, that did break up through 80. We said we had this surge up consolidation pattern, and then a likely equal leg movement up into 83. We've had this week a little bit of inventory pushback, but the weak dollar is having its play. That the Red Sea and the Hamas conflicts are slightly on pause. So we just had enough room to move. But look, the divergence that's come in, that to me looks pretty much like it's a third wave type thing. I'm going to get a lower momentum mark for the final high. And that, that's happened before here on the first surge up. The third wave had the highest momentum and it finished off with a much lower momentum. I think we're going to replicate that. And then we go back to fundamentals and oil drifts off, but still got 2 or 3% to play with on the upside. See if you're interested. I've not drawn any charts this week for the US dollar pairs, the GUI, the EU, the Aussie dollar, because if we are in to a dollar breakdown scenario, those are the three that are really going to go. And we said last week, it looked very much like in the shorter time frames, they were looking for a bottom, 4 hours and 1 hour, daily and weekly, set up for breakouts to new short-term highs. I play that. Yen pairs in this scenario are also worth buying. Why is that? Ignore the US dollar, Japanese yen read through per se. It's more the fact that risk on is the carry trade. So any yen pair outperforms. The yen obviously is weak relative in that situation. Risk on, you're buying the left-hand side of the pair. So that's enough for charts for today. Week ahead, as I said, when do we start consolidating last week's moves? All depends on whether this January data was a one-off or not. We've got services data this week. I mentioned it earlier, not normally the seasonal strength, but it is this year. We need that to drift out of the numbers. Otherwise, it's reverse engines, all the good work we've done. And obviously, we're never going to get through, at the start of a month without non-farm payrolls. They're expected to pull back into the 180s from the 350 last month. Net, it doesn't really matter too much as long as it's not super blowout. As long as the average hours worked stays in line, the average earnings per week stays in line, the unemployment rate doesn't keep tightening, then it should be seen as a growth factor. Look out for jolts in the earlier part of the week. Their number of job openings really did feed through to non-farm payrolls last month. Any kind of yield push up, and we start getting problems. We highlighted earlier that one standard deviation below the normal auction pricing. We don't want to get into this fiscal profligacy argument right at the same time that they're trying to settle in the Senate to avoid government shutdown. I've mentioned Hunt has already come out in the papers. The budget should be a nothing done, and he will be the last person that wants to upset any chance of rate cuts, because that's what the Tories need going into the election. They need to see rates coming down so they can pretend that they are running the economy properly. Powell returns to represent in front of the Senate Joint Economic Committee. That starts on Tuesday and Wednesday for 2 days. Wednesday and Thursday for 2 days at 3:00. That's the first time he said anything for a couple of weeks since that 60 Minutes interview. So not a lot out on Monday. Tuesday, we've got some Japanese CPI, more Chinese services PMI from the private sector. UK's got retail sales. We need that bounce back. Have you been to the hairdressers since last month? But there was a lot of rain in the UK, record rain in February. That doesn't normally feed through to good retail sales, so just be aware. Lots of PMIs in Europe across the board. And then obviously ISM services on Tuesday, which we said need that prices paid element to behave. Wednesday, Aussie dollar GDP, watch the crosses. New York session, we've got ADP as well as jolts. Last month, ADP, totally rubbish for read through. That's the private payrolls part of the economic numbers. Bank of Canada rate decision, not expected to do anything. They've got their IV PMI for February as well. That's expected to fall back slightly. Construction PMI in the UK before the spring budget. Thursday, Halifax update, see whether that says the same as the nationwide that came out. Then we've got the ECB rate decision on Thursday. Nothing expected to happen there. It'll be the same rhetoric and talking about wages, I think. Swiftly after that, US non-farm productivity. That was a boost last month and really helps with the slowing rate profile. As long as we can have this growth argument, as long as productivity is coming through, it shouldn't be inflationary. Eurozone GDP on Friday has been flat. Hopefully it doesn't slip into recession. German manufacturing was poor, remember, last week. We've mentioned non-farm payrolls. Stock-wise, it's pretty much at the end of the season now. US Target, Costco and Gap are the main guys and the retailers. We might be able to get some tweets out of that. Clarkson, UK shipping stock updates on Monday. That might just be interesting for giving us an update on what's happening in the Red Sea. These guys do rescue vehicles and all sorts of things. ITV full year numbers will be interesting because they jumped 14%, I think, this week on the back of selling BritBox to BBC. You've got Ashtead, which is a large infrastructure leasing company, massive in the States, tied into a lot of the US programs, so that'll be an interesting read. And then Europe, quite a few sort of double-digit billion market caps: Henkel, Thales, Bayer, Deutsche Post, and Petrobras, Merck, Continental, Vivendi. So a little bit of interest in Europe for guidance for sectors. No speeches from the EU this week because they're going into their rate decision. A few talking heads, Harker and Kashkari on Monday. Ueda's back to back up his Friday comments, I presume. Barr speaks on Tuesday night. See, Powell, I said, he's back for 2 days on Wednesday. Daly is speaking Wednesday. Nakagawa, Bank of Japan board member on Thursday. See which side he goes for, Takagawa or Ueda. Baltz speaks as well, and then Mester brings up the rear on Thursday. Friday, pretty quiet. Williams coming out at lunchtime. He has had effects before when he's come out pre-big data, so watch out for him. And surely Daly, makes an appearance again at the end of the week. She's not cited to at the moment, but tends to not ever be the last person to speak on any 1 week. So there you have it. Lots and lots to ponder, lots in the mix. It could easily turn on its head with a slight uptick in the data. Be aware, be nimble, but if anything, be careful with the shorts, because this really does feel like we're preparing to leave the nest. Good luck, traders. See you soon.